Markets are focused on rate cuts. The latest inflation figure clearly is showing to all of us that inflation is persistent. The data coming from the United States is not positive. All of the items except one in February continued to rise. Inflation, therefore, is persistent, and there's a very clear reason for it, which is massive government spending, massive deficit spending, which means that the headline figures of GDP, employment, and of inflation are going to remain relatively stable. With persistent inflation, relatively low unemployment, bloated by government contracts and government hiring, and relatively stable GDP, bloated by massive deficit spending and debt, what we end up having is an environment in which central banks are not going to cut, certainly not as fast and certainly not as much as consensus assumes. More importantly, what we need to understand is that it is impossible for inflation to reach the level that consensus assumes for the end of the year if government spending, deficit spending, continue to be as aggressive as they are. And they're likely to accelerate in a year of elections. Therefore, the reason why we remain relatively positive on the headline figures of the economy, GDP, employment, and the improvement of the overall figures is basically because they come supported by artificial activities, i.e. by printing more money, i.e. by deficit spending. That is not growing. That is getting fatter. And that is not good for the economy in the long term. But it doesn't justify rate cuts either.